Today, waiting for an inflation signal. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with a distinctively Australian flavour. Well, in the wake of the 50 basis point interest rate hike by an increasingly hawkish Federal Reserve, markets have gyrated wildly ahead of this week's US economic data, which will be closely parsed for signs that inflation is peaking or not. And the point here is that inflation could sometimes go high briefly, but then come back. So, for example, when GST was implemented a couple of decades ago, it flowed through the system, but then everything settled down. Or inflation could go higher, but then keep going higher because of the second-order effects. For example, oil prices go high, but those costs then transfer through the rest of the economy, and everything else goes up too. Then wages start to rise, and so on. So at the moment, many analysts are believing that the peak in inflation has passed and that from here things will ease back. And the base effect will work its way out, and therefore the number will come down significantly. Well, maybe. But then there are others who are thinking that maybe inflation is more embedded, more widespread, and therefore the underlying inflationary trends will remain higher for longer. And that may, by the way, reflect some of the liquidity that got pumped into the market over the last few years, as well as other factors, including Ukraine. Anyway, shares swung from their early opening surge to losses on Tuesday after comments from Cleveland Fed President Loretta Mester. "We don't rule out 75 basis points forever," Mester said in an interview. "When we get to that point in the second half of the year, if we don't have inflation moving down, we may have to speed up." Mohammed El-Erin said in a tweet, "I worry that all the Fed speak since last Wednesday's Fed policy meeting has done more to confuse markets than reassure them." And separately, BCA Research's chief global strategist Peter Brazin said the sell-off has opened the door. "We tactically downgraded global equities in late February, but see the current level of stock prices as offering enough upside to warrant an overweight." But price growth has soared to the highest level since the early 1980s due to the collision of a post-pandemic demand boom and the gummed-up global supply chain. And it's also stoked fears that the Fed's aggressive attempts to rein it in could lead the economy into recession. The Labour Department's job report last Friday provided the first potential sign of a plateau, possibly, with monthly wage growth decelerating to 0.3% from 0.5% and holding steady at 5.5% year on year, although that's still a big number. On Wednesday, analysts expect the Consumer Price Index in the US to show a sharp pullback in monthly growth, cooling to 0.2% in April from 1.2% in March. That was the biggest monthly jump in more than 16 years, and an annual increase of 8.1%, 0.4 percentage points lower than the prior 8.5%, which was the hottest read since December 1981. Mind you, 8.1% is still massive. Energy and food prices were the culprit, exacerbated by fallout from the Russia-Ukraine war. Russia's invasion of Ukraine has magnified the pace of inflationary pressures this year, and the Fed can't do much about that, said David Carter, managing director at Wellspire Advisors in New York. Energy prices post an 11% monthly jump in March, with gasoline surging by a jaw-dropping 18.3%, and average prices at the pump hit a record high in March, according to Motorist Group AAA. Food eaten at home rose 1.5% on a monthly basis, and grocery prices rose by 10% year over year. That's the fastest annual growth in more than 4 decades. Stripping out food and energy prices, the so-called core CPI is expected to have edged up by around 0.4% last month, but cooling to 6% from 6.5% on an annual basis. Now, I guess any sign of deacceleration would be welcomed by the markets. If the inflation prints as expected, it would be the first meaningful decline in the annualized inflation rate since the depths of the COVID recession, wrote Matt Weller, global head of research at StoneX Financial. And Thursday's produced the price data, which reflects the prices US components receive for their goods and services at the figurative factory door, are predicted to tell a similar tale. Consensus estimates forecast a sharp deacceleration in headline PPI and a slower showdown when stripped of food and energy items. Recent survey data, particularly from the Institute of Supply Managers, Purchasers Managers Indices, reveal the two main drivers of inflation, supply scarcity, and the ongoing worker drought did remain significant headwinds in April. And on Tuesday, while 32% of survey participants in the National Federation of Independent Businesses Business Optimism Survey rated inflation their top concern, that's a record by the way, fewer respondents reported raising prices and hiking wages. And so many companies have been able to pass input costs along to their customers. In fact, the S&P 500 12-month forward profit margin is actually increasing. As at May the 6th, that figure was 13.4% higher than the early May readings, going back at least 12 years, according to the data that's out there. Corporations have been able to pass on higher costs as demand remains strong, Carter added. However, if the Fed's interest rate increase cools demand, companies will be unable to pass along higher costs and margins will shrink. Under the hood, there continues to be signs that inflation, labour market tightness and supply chain woes may all have peaked, said Yuan Ma, Chief Investment Strategist at BMO Wealth Management. The market is in prove-it mode, and those early signs are still far from adequate proof to calm the markets. Now, all of that is, of course, tomorrow, but ahead of that, the Dow Jones ended lower on Tuesday after reversing a more than 500-point gain intraday as investors remain wary of making big bets on stocks a day ahead of the inflation data. Dow Jones Industrial Average fell 0.3%, the S&P 500 rose 0.24%, and the Nasdaq gained 1%. Tech lost some steam into the close as dip buying action, which was seen intraday, slowed, even as Treasury yields took a bit of a breather. Microsoft, Alphabet, and Apple led the gains in big tech, all going 1% higher. Facebook and Amazon also ended just above the flat line. The 10-year Treasury yield fell further, actually below 3%. That's a day ahead of those inflation data expectations, and it could potentially bolster investor sentiment, but we'll see. Investors are looking for signs of a potential peak in the inflationary pressures that we've encountered over the last few months, and if they get a hint of anything close, the markets could be set to stage a strong rally in our view, January Montgomery Scott said. Peloton Interactive, meanwhile, closed about 9% lower as the connected equipment fitness company delivered guidance that fell well short of estimates after reporting a wider loss than expected in the third quarter. The stock's been down more than 20% intraday. Our Q4 outlook reflects softer demand compared with our February forecast, Peloton said, adding that its subscription price hike had led to an increase in cancellations, but the impact was expected to be modest. AMC Entertainment fell more than 5%, even as the movie chain operator reported quarterly results that beat on both the top and bottom lines as box office hits, including The Batman, spurred a return to the big screen for moviegoers. And healthcare stocks were boosted by a 4% jump in Biogen after the drug maker made further progress towards the potential approval of its proposed Alzheimer's disease drug. Novavax cut losses to trade more than 1% higher despite reporting quarterly results that fell short of Wall Street estimates. Energy stocks shrugged off a decline in oil prices as intensifying lockdown measures in Shanghai continue to stoke fears about demand. The strict zero-COVID strategy in China is putting the brakes on oil demand there, Commerzbank said in the note. Halliburton, Devon Energy and Occidental Petroleum, each up more than 2%, were among the biggest gainers in the sector. The Volatility Index was down 5.06% to 32.99. Gold futures for June delivery was down 1.04% to 1,839. And elsewhere in commodities trading, crude oil for delivery in June fell 2.92% to hit $100.08, while the Brent crude contract fell 3.03% to 102.73. The euro-US dollar was unchanged at 105, and the US dollar futures index was up another 0.23% to 103.93. But Bitcoin fell for a 7th consecutive session. The latest decline in the price saw an intraday low of 29,944, and that followed a peak of 33,312 on Monday. Today's bottom is the lowest level prices have traded since June 2021, and overall Bitcoin is now trading around 55% lower than its record high in November. And the world's second largest cryptocurrency also fell during today's session in the US, dropping below $2,300 for the first time since January. The Ethereum price hit an intraday low of 2,206 earlier on Tuesday, which is the lowest level achieved since January the 24th, when prices went to a floor of 2,150. The latest drop comes as yesterday's support point of 2,350 gave way, following a 6-day losing streak. And currently there are 3 major reasons why the economy may continue to flounder until things begin to change. The reasons, of course, include the ongoing war in Europe, the current COVID-19 outbreak in China, and US bond market yields. The first is simple to understand. War is not good for the economy except for firms like Raytheon, Lockheed, Northrop, and General Dynamics. While a great majority of stocks have plummeted, 6-month statistics show the aforementioned company stocks have seen significant gains. For the rest of the ordinary citizens, though, war is leading to more inflation. Significant financial sanctions against Russia have made it so many countries will not transact with the country. This has caused the tightest financial sanctions in decades, which in turn has caused the price of goods and services, and especially petroleum products, to skyrocket. Trend forecaster Gerald Celente recently detailed that as long as the Ukraine-Russia war ensues, the odds of recession increase. And many other forecasters and financial analysts believe that as long as the war continues, the US economy will slow and Europe will risk a recession. Another factor that may impede the global economy's healing progress is China's recent COVID-19 lockdowns. During the past 2 months, China's authorities have tested a 2-phase lockdown strategy in Shanghai with its strict zero COVID-19 strategy. The measures China have been leveraging in recent times have shaken investors, according to various reports. In fact, 5 days ago, New York Times wrote that China's COVID-19 policies are making it so that European investors are wary of investing there. And the New York Times highlights a survey that says lockdowns and supply chain issues have soured European businesses in China on the idea of further investment in the country. China's lockdowns and the zero COVID-19 strategy have investors shaking in their boots because of what happened in 2020, when China was dealing with COVID-19 in early 2020. Today, investors are frightened that the lockdown process could happen again, and China's zero COVID strategy will spread to other regions worldwide. And in turn, of course, an event like this could again shut down global markets, impede supply chains, and cause economic chaos. And of course, in China, we've also got the property sector, which continues to grind lower, and there's no clean exit out of that either. The final problem that is hurting financial investors are current bond market yields, which are wild and erratic these days. On May the 10th, reports showed that the 10-year US Treasury yield slipped by 3%, as fears of rising inflation and a potential economic slowdown lingered. In addition to US bond market carnage, bonds in Europe have been extremely volatile as well. The reason people fear bond market volatility is because bonds are operational investment vehicles with long-term yields that affect fixed income investors. Bond markets have been tanking for weeks on end, and many believe the economy won't heal unless bond markets stabilise. The broken bond markets are also being blamed on the Ukraine-Russia war, but they were showing signs of weakness well before the conflict. And of course, younger generations of bond investors have not felt volatility like this before. The director of global macro at Fidelity Investments, Jurian Trimmer, said the current bond bear market is historic. And in the same report, JP Morgan Asset Managers Chief Investment Officer Steve Lear said the broken bond market is painful. It's been a real and significant and painful move, Lear said. For those who haven't experienced a bond bear market, this is what it feels like. So these 3 factors are sores on the global economy. Unless they heal, an even deeper recession could be on the cards. Presently, the Ukraine-Russia war continues. China's lockdown measures are still shaking investors, and bond markets have been erratic for weeks on end and continue to rattle investors to this very day. Now, critics argue that it's not surprising that central bankers were blinded to the risk of an inflationary outbreak. After all, inflation has been so low for so long, they expected price pressures would remain muted indefinitely. What's more, central bankers are vulnerable to a type of groupthink, given that they all attend the same conferences and read each other's research papers. As a result, central bankers shrugged off the warnings of former US Treasury Secretary Larry Summers that the combination of massive budgetary stimulus and ultra-low rates would set off inflationary pressures not seen in a generation. In fact, it wasn't until last November that Jerome Powell, the head of the US Federal Reserve, signalled his growing anxiety about rampant price pressures by indicating the US central bank was preparing to speed up the withdrawal of extraordinary monetary stimulus that was unleashed in the early days of the pandemic. Powell also conceded that transitory was not an appropriate description of the stubbornly high US inflation, saying it is probably a good time to retire that word. Some former Fed officials believe the US central bank set itself up for a misstep on inflation in August 2020. That's when it officially dropped its long-standing practice of preemptively lifting interest rates to head off inflation. The Feds didn't change its 2% inflation target, but it said it would allow inflation to run above target for a period to compensate for periods when it was below 2%. Last week, William Dudley, the former head of the New York Fed, said the Fed's shift to a regime of targeting average inflation was in fact to blame for its tardy response to rising price pressures. By definition, it was going to make them very late at some point, he said. And Dudley was also pessimistic that the US economy would be able to avoid a recession. The chances of Fed officials achieving a soft landing in this cycle is almost zero, because every time they've had to push up the unemployment rate in the past, they've also ended up in a recession, he said. So the stakes are getting higher now, with, on one hand, the prospect possibly of inflation topping out, but on the other hand, have central banks left it too little too late, taken rates too low, and are behind the eight ball? Well, we'll see. But I do think at the moment markets will remain highly volatile. And I wouldn't expect anything other than a bit of a bounce tomorrow on the CPI number. But then, of course, there's always a risk of more falls later. Stocks, fundamentally, I think, are still pretty much overvalued. And therefore, risk of the downside remains pretty strong. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.